Good afternoon, everyone. Thanks for joining us. We have a very long overdue update with Akiba Leisman, CEO of Mako Mining. Last week, we actually hosted Akiba to discuss Sailfish, so anyone looking for an update there can find the replay on the Adelaide Capital YouTube channel. This session will focus, as you guessed, on Mako Mining, of which Akiba's CEO. Mako trades on the venture under the ticker MKO and under the OTCQX under the ticker MAKOF. There will be a substantial Q&A part to this. I think we'll start off with a bit of an overview and an update on recent results and direction of the company, and then we'll go into Q&A. So feel free to input those questions in the Q&A box at the bottom of your screen. And as always, this presentation will contain forward-looking statements. If you'd like to know more about those, you can find them on the company's presentation on their website. With that out of the way, I'd like to introduce Akiba. Thanks for joining us.
All right, thanks, Deb. Always a pleasure.
It's been a while, so looking forward to getting an update and exciting times as you transition your production over to Las Conchitas. So looking forward to hearing about that. Why don't you start with a bit of an overview or an update on what you think is relevant for investors?
Well, sure. I think even the rationale for us not having an update for a while is kind of all connected to what's going on operationally, and then even from a corporate perspective. I never really understood exactly why we became such a controversial company, to say the least. But our main business plan was fairly simple: is that there was a relatively small resource, initially put together by the former management group, that needed to be resolved. So we needed to do a lot of geological modeling and make sure that we had the rigor and approach to get our resource over at the San Albino mine up to snuff, not for the public markets perspective, but for the fact that we were actually going to go and mine it. And we had to do what we said and use the cash flows to do what really is the important part for our activities within the country of Nicaragua. So the cash flows that came from San Albino, which we started to mine, I guess it's pushing almost 4 years ago, when we started to mine the open pit over at San Albino. And the plant started up just over 2.5 years ago from there. But the cash flows coming from this relatively small open pit deposit was intended to do a few things. It was intended to be recirculated into a exploration, discovery, and drill program over at a satellite area called Las Conchitas, which we put out some truly fantastic infill results both this morning as well as last week. And then the intent was to develop a resource and then start mining it and going on to the next deposit as a satellite to San Albino, and do this in a way that didn't involve raising any additional capital, whether it be debt or equity over at the company. So the anniversary of our last equity raise, actually, I think we may have passed our 3rd year anniversary of this. So we raised the equity capital and raised the debt capital to go and build San Albino. And while there have been a few refinancings here and along the way, the capital that we raised to go and build the San Albino project allowed us to get to the point where we were able to develop what is soon to be a public resource over at Las Conchitas. We've kind of alluded to it in our last couple of press releases. They'll have an initial open pit mine plan of around 5 years, and then a more substantial underground resource associated with that as well. And then also to kind of crack the code with what we had on our ore body, which we think makes up the bulk of our 188 square kilometers of ground over in Nicaragua. This is a unique type of geology for the region, and it wasn't really very well understood, even with quite a lot of study behind it. So using that cash flow, we were intended to do a couple of things: grow the business organically, and then also to go and explore and crack the code of what we thought was an orogenic system. And this is kind of where I think the marketplace has got a little bit out of whack in terms of what we were trying to do. I think, as I explained it, nothing that I said actually and how I described it sounds nonsensible. But I do think people have been trained in this industry to look at projects as projects. And basically the way that the industry has been set up is that junior mining companies are there to go and prove out a project, some successfully, some not, with the idea that it will be sold to a larger company with the capital and operating credibility to go and turn into a mine. And sometimes that works great. I never begrudge anybody for having a successful exit along those ways. But sometimes it doesn't actually work all that great. And we took an approach really early on, is that we were going to be mining this ourselves. And to do that, we had to do things in a very specific way, make sure that we understood the technicals behind our mine initially, and use that kind of as an anecdote and a template for other deposits and other satellites within our land package. But at the end of the day, it was us that was going to be going and mining this. So last year, 2022 was an interesting transition point, right? So this is not a simple mine. It's not a simple mine geologically. It's not a simple mine metallurgically. That's why a lot of drilling needs to be done for us to understand it. And likewise, at the beginning of last year, we had some metallurgical issues associated with the mine. You can see on the foreground of the screen over here. This is from, this picture is probably taken about 18 months ago, and you can just start seeing the transition point from when we were in the oxide material, this brown mocha colored dirt, to this blackish material, which is carbonaceous schist, almost like a shale deposit. And carbon sometimes is perfectly benign within your cyanide and carbon recovery systems within our carbon and leach processing plant. Sometimes it's not benign, where that carbon can kind of interfere with the carbon that you put in your leach tanks to go and recover the gold. And we had some of those issues in starting in February of 2022. It took actually quite a few months, if not quarters, to resolve. The way that we needed to resolve it was to make sure, first and foremost, to be mining this thing with a level of precision that I don't think is replicated anywhere else in this industry. If people, especially with a mining background, what we're doing with this deposit is that we tend to have a relatively narrow vein system. The average vein maybe across our ore body is about a meter. Sometimes it widens out to something substantially more. And in fact, in the press release that we put out, an 11.5 estimated true width thickness within a zone containing 12 gram material plus just gold plus a silver byproduct credit associated with that. So sometimes it balloons out. Sometimes the veins duplicate. Sometimes it widens. Sometimes there are individual boudins that develop within this relatively complicated ore body. But on average, our veins are a meter and a quarter wide. So when we tell people what we're doing, and this is an open pit mine, they say, wow, you must be experiencing a lot of dilution when it comes to your mining operations. The fact of the matter is we've developed systems over the course of the last 4 years, internally generated through our very an interconnected interdisciplinary program between our mine site geologists and our mining engineers, where we'll be able to come up with a system in place where we can control mining dilution to within 30 centimeters on either side of that vein. And that becomes important from a couple of perspectives. It becomes important is that we like to say we are Nicaragua's newest high-grade gold mine. High grade has a lot of emotive qualities in this industry. So certainly we like to have high grade going through our plant. It helps with our costs. It's also more important than that, in that the vein, in terms of how it reports and what kind of preg-robbing carbon is associated with it, there really isn't much. So when we have high grade and we're in the vein, the material responds beautifully. You're going to get 90+% recoveries if you're going to be mining this with a spoon. The problem with our ore body is the stuff on the outside. So it's the stuff in the hanging wall and footwall. That's where the real, the host rock, this carbonaceous schist, where sometimes it's benign and sometimes it's not benign, becomes a problem, because that carbon going into the plant can interfere with your carbon recovery systems and your CIL plants. So it needed to be mined this way. We need to mine at a precision level, and we need to develop these systems in place that can control this mining dilution to roughly 30 centimeters on either side of that vein. So having that was essential. Then on top of that, we developed processes and procedures to have blend material going in to help minimize some of those recovery issues. And that does require us mining from multiple areas of the mine, because sometimes you want to have good material being mixed with good material. Sometimes you want to have bad material being mixed with bad material. Sometimes you want to have, albeit high grade and economic material. And sometimes you want to have a mix of both, depending on what kind of head grade you have, what kind of recipes you have for cyanide concentrations and other chemicals that go throughout your system. And you make sure that when you add cyanide to your plant, it happens only after you have the ability to extract as much as you can through gravity mechanisms, and then B, the first time that a cyanide solution is seen within your ore slurry is when it's in these carbon and leach tanks, where you have your heavily activated carbon that preferentially responds to gold in solution rather than the carbon within the material. So developing those recipes over time also took some time, and then also we needed to open up different areas of our mine to make sure that we had the appropriate level of blend. So all of this is being worked on 2022. And then lastly, in terms from a corporate perspective over in 2022, I did come to the conclusion, frankly, this happened even when we started in 2018, 2019. I've always thought that Mako was going to be too small to be a relevant mining company within the public markets as we exist. So right from the start, I said, look, we have a lot of organic growth opportunities within our land package, but because of the complexities, what we need to do, the types of drilling that we need to do, types of capital that we need to put in to go not so much on plant expansion, that's a de minimis amount, but actually on putting that money from an exploration perspective, you're never going to be able to get this thing operating at more than 1,000, 1,100 tons a day. And then at our blended head grades, in terms of what that means, that probably would equate to around a 70, 75,000 ounce a year producer. It could be a very profitable mine, it can be a wonderful enterprise, it could be a wonderful company. But in its position as a public company, it's not going to develop the ideal platform, if you will, as a public company, a public equity, a public stock. The ability to kind of utilize our very high quality management team, our operating management team, in order to go and de-risk a lot of mining assets that can potentially be added to the portfolio. So M&A has always been part of the strategy over at Mako right from the start, but it became more apparent that it needed to get done in 2022. So you can imagine the situation over at the company. We had some operating issues that we needed to resolve. And then we were trying to execute on some of these external opportunities as well. And then, lo and behold, October of last year, we get hit completely out of the blue. It was unexpected. I'll give you a funny anecdote about it about later on. But there was a new round of sanctions that were put from the U.S. government onto the Nicaraguan gold mining sector. So this was the second round of sanctions that were hit on the gold mining sector. And while it didn't impact in any material way our operations, it certainly impacted at least for an intermediate period of time, the market's willingness to finance, capitalize, accept this jurisdiction as a mining jurisdiction. Now, I'll be frankly, I've actually had a wonderful experience in Nicaragua, starting from as a director of the predecessor company going back to 2014. There's always been a willingness to help support the gold mining industry. I have not seen any direct levels of corruption, at least as it related to the government and us. I think it's been very clean, very open dialogue. And again, this is specific to the relationship between Mako and the government, and Mako to our communities, Mako to our employees, Mako to our broader stakeholders. So as an operator operating in this country, couldn't be more pleased where we were or in Nicaragua. As a public company with a single asset in Nicaragua, in terms of what the capital markets are willing to finance and investors are willing to invest in, that was a little bit of a different story. So towards the end of last year, it was a little bit of a head scratcher in terms of what we were going to do, is that we were coming out for some of our operating issues. But it was still in a situation where the marketplace, it was very difficult to go and finance and accept like a small single asset producer in Nicaragua. So there's a few things that we needed to kind of go and change from our business operations. So the first thing is that you can even see on our presentation, which still discusses some of our long-term plans of growth, is that the initial plan was to take our 500 ton per day mill. All the civil works were laid out to go and expand it to 1,000 tons a day. So a very small amount of capex would have allowed us to double production from a fixed infrastructure perspective to 1,000 tons a day. But in order for us to have a resource, a sizable enough resource that we were comfortable with how quickly it was going to get depleted, it really would require quite a lot of exploration capital to get on, to get that type of resource and that kind of platform in order for us to be mining and processing at 1,000 tons a day. We peaked out at our exploration spend in Q3 of 2022 at $3.9 million for a quarter. So it was pushing about $15.5 million a year on exploration expenses. So one of the first things that we did was, I don't even want to say cut the budget, but we certainly had to look at being smarter about how we were going to go about our exploration program in order to save money. And this decision path had two fundamental decisions that were made. One, I think, was a home run success, which I'll talk about in a bit. It's related to the news releases that we put out today and last week. And one where I think in the rationale for the decision was correct. So the thought process was correct, but the outcome was not what we expected it to be. And I'll go over that in just 1 second. The first thing that we did is we basically eliminated our diamond drill program, and because at one point we were operating with 7 diamond rigs over at site, and we replaced it with a reverse circulation program. So this was the meat behind our infill program. So we've done 232 holes this calendar year. Each hole averaged about 40 meters of depth. So this was just over an 8,000 meter program. And there was a lot of question marks about how RC would perform on an ore body. Like I mentioned before, these are 1 meter wide veins. So it's a very narrow vein system. When we take and we mine this with 30 centimeter dilution on either side, when we do an RC rig, unlike geologically observing our diamond core, we can't really get sample sizes less than a meter for an RC rig. So you're going to have within your chips that come from this rotary drill program, gold grades that inevitably will be diluted and inevitably will have less geological clear demarcation points and separation points than you would observing what is in the core barrel, where you can actually have a geologist and actually see the contact points for the various types of lithology and geology that we had. This was a risky decision to do because we knew that there was going to be some issues associated with the data that we got. In fact, like all of this RC work that we've released over the course of the last week, all of it is being used to refine our geological model. None of it is being used to estimate grade for the upcoming resource estimate, just to be clear about that. What we found out is that RC is fantastic for kind of understanding where the geology lies, whether you're modeling it correctly. It's fantastic to define whether there's no gold, whether there's a little bit of gold, or whether there's a lot of gold. And that's actually very valuable information in terms of what we had. When we started on that program, it was a debate about whether that type of data is going to be sufficient for how we're going to be mining and planning this going forward. So I'm definitely proud to report that our RC program has been a fantastic home run success, to the point where I'm very hesitant about starting up, other than some confirmatory drilling, our core program. Because not only does it save us probably 40 to 45 cents on the dollar by doing this program, it's also a lot quicker, right? And you can see in the news release, I think one of the more surprising things that I put in the news release is that we drilled 232 holes this year with 1 rig. That's probably about the pace that we were drilling with 5 rigs with our core program. And the fact that we actually now have comfort level with how the ore body behaves obviously there needs to be a component of core in order for you to model your resource correctly. The RC program has been a lifesaver. It really, really allowed us to cut down our exploration spend from a dollar perspective, but the amount of and quality of the data that we got from this program was I think 80% of the quality that we would have gotten from anything that we would have had on using the 5 rigs that at one point were over at Las Conchitas. Now, the decision that was made that did not pan out. Now, and again, I actually think the rationale for this decision was correct at the time. But it was in October, and we knew that we were going to need to permit Las Conchitas. And really, permitting is very transparent in Nicaragua, and there are a few things that you have to do by the law, and then there's a few things that you de facto need to do in order to get your permits, and there's certainly obviously part of that is getting community buy-in and support. From a capital perspective and a practical perspective, owning those surface rights are really the key indicator. So we obviously acquired all the surface associated with San Albino. That's all the way on the left. And Las Conchitas, one of the first things that I did when I took over as CEO of Mako back in 2019 was make sure that we acquired all of the surface rights that contained the good stuff, the sweet meat of the Las Conchitas ore body. But it wasn't everything that we needed to get permits. So here we are. It comes in October, and we're saying, all right, operational problems are solved, and we're ready to go. We're even talking to this other company about M&A. So I'm going to put out some really good drill results. And then in October 2022, we put out our best drill results of the year. And here I am on Twitter saying, hey, look how good these holes are with nice, funny shark memes associated with it. And then 10 o'clock in the morning, the sanctions come in from Joe Biden, and it kind of eliminates our ability to do a lot of the things that we were operating. So one of the things that we decided to do in order to save capital was to break up our permitting in 2 units, to acquire the surface rights that we absolutely needed in order to start mining Las Conchitas simultaneous and in parallel to San Albino, in order to make sure that we were maximizing our and optimizing our blend feed. And this is both in terms of grade, because we wanted to make sure that we maintained a roughly equivalent head grade throughout. And also, like what I was talking about earlier, is that we do have very specific optimized recipes of the types of material that are going into our plant in order to make sure that our recoveries are as high as they can be, knowing that there are complexities with our ore body associated with this carbonaceous schist. So Las Conchitas was a key element of our 2023 mine plan, such that really starting in February, it was expected to be roughly 40% of our mill feed. And then by 2024, it was going to be 80%. And then by late 2024, 2025, it's going to be 100% of our mill feed. So we made the decision in October to defer some of those surface rights acquisitions and then focus kind of on satellite areas, or not satellite areas, but kind of like core areas of Las Conchitas in 6 different locations, and get a temporary permit. Call it a bulk sample, a metallurgical permit, whatever you want, but it was going to be sufficient enough for us to get enough feed to the mill in order for us to then go back, acquire all the surface rights that we needed, and then apply for our full EIA. This was the decision made solely on the back of looking at our balance sheet and making sure that we had the right approach, the right capital management to take care of everything that we needed to do. And part of that was maintaining our exploration program. And part of that was making sure that every single dollar of ours on our balance sheet became precious. So we were in daily communications with the Ministry of Mines. I don't think they've seen a bulk sample permit before. So a lot of the things that we were asking were novel, which is always never a great thing to do for a permitting agency. But to Nicaragua's credit, they kind of accepted kind of what we were trying to do. But it became clear that there was some hesitancy about going through this approach. So we were expecting this permit in February, didn't happen in March, didn't happen in April, didn't happen in May. And then like some alarm bells started to ring over the company, like, we kind of need to be mining Las Conchitas right now. And then finally, we got the permit in June, and then we started the devegetation work, started mining actual ore material on a small amount. It still needs to be ramped up in early July, and then we started processing the material last week, which was the first update. And throughout all this time, we acquired the key surface rights on the deferral. So that decision in October that was made kind of in indirect response to the sanctions to make sure that we were actually capable of preserving our balance sheet to the extent that we did. The plan was, instead of actually just submitting our EIA outright and get approval for the full permit, to do this in stages. I think in retrospect, the delays associated with this permits wound up not really helping us all that much. It would have been just easier if we got the full EIA submitted and approved right now. So I don't think this is the difference between mistakes and being wrong, right? So I think the thought process was correct back in October. But because of kind of you have to interact with regulators, and especially when you try to do novel things for very rational reasons, sometimes that can cause hiccups operationally. So the practical impact of what this meant is that normally our optimized blend over at the plant, you kind of want to run 50% run of mine material. So that's the diluted veins. So that's the good stuff, the 17-gram veins. And then you dilute it on either side 30 centimeters. That takes down, I think our average head grade for the diluted vein since inception has been probably about 13 grams. So you take that 17 down to 13 with that small bit dilution, but you blend that with 50% other stuff. So that other stuff can be some of that problematic hanging wall and footwall that we test about whether it's benign or not so benign. So we separate those in very detailed fashions by using our preg robbing tests that we've developed internally, and then using some external equipment to do that as well. And then it should be running kind of like 50-50. And then really since March, it's been running 35-65-ish. So this does a few things, right? So by definition, arithmetically, so if anybody that can do algebra, this winds up taking your head grades down. So if you're running 35% run of mine material, this 13-gram stuff, and 65 instead of 50-50, that's going to basically take like a couple gram hit to your head grade, just arithmetically. And then there's the more subtle point, is that when we don't actually have the access to the types of material and the blend that we need, it also means that from a blend optimization, a metallurgical optimization, we don't have the exact material that is necessary to run our plant as efficiently as we can. So it's absolutely essential to get the Las Conchitas permits, not only to get our head grades up, but also to make sure that we have access to the various types of material to make sure that the plant is getting optimized the way it needs to be optimized. And all of these decisions are coming essentially from a capital constrained company. So I never like to be in a situation where decisions are made because of balance sheet, but that was kind of like the position that we had, and it's one of the risks of having a company that doesn't actually have a lot of cash on the balance sheet, is that some of the decisions were made that would have been different if this was a company that was flush with cash, had a war chest, overcapitalized themselves at all. So there are, I guess the point that I'm trying to make is that decisions have ramifications. And my job is to make the best decisions under the constraints that I operate under. I try to avoid making decisions on the back of constraints, and try to eliminate as many constraints as I have, because we actually have a lot more tools available to us in our toolkit than most junior mining companies. We have a controlling shareholder with access to capital. It's a fantastic asset for us to have. We have a truly like roll your sleeves up type operating team, some of the best people on the planet for doing scrappy little mines like this. So the ability to actually pivot on a dime, and using these things, we try to make the best decisions with what's available to us. And we do things, I think, in a better way than most mining companies would do if they were put in similar positions to us. So throughout all this time, you get the snapback from the market. It's like, oh my God, like what's Mako doing? Oh my God. It's like, oh my God, their head grades are down here and there. Like it's all of that is coming from rational decision points that we made in response to where we were last year. So now we have to kind of like get back in line. So we've been starting to process Las Conchitas material for a week now. So it really just started. The last few days, our head grades are up by 2.5 grams from what they were previous in the month, and then our recoveries are going to go up as well, not only because of optimized blends, but also just because of the head grades. We tend to have like a positive correlation between recoveries and head grades in general, and then we're now back to where we were in the beginning of October 22. Is that, come on, like Mako needs to be structured as a company that eventually is going to have relevancy in this market. And I like environments like this when everybody's apathetic, everybody's kind of on edge, everybody's like a little bit nervous about what's going on. These are the times and the moments where we're able to execute on things because we have tools in our toolkit that aren't available to other companies in a similar size and position to us. So that's kind of what's happened. Now, the great thing is that Las Conchitas looks fantastic. So we've kind of alluded to the fact that it's got, we have like an internal 5-year mine plan. We'll see what Mr. Ristorselli is going to sign off on in terms of what the open pit is going to look like. I don't have like a really great sense on what the underground is going to look at just yet. I could say topographically, I'm not sure if this is like a great slide to look at it. I guess so. But you can sort of like squint your eyes and see topographically is that you have certain veins within Las Conchitas that go into the hill, whereas San Albino, the main productive vein, kind of like goes alongside the topography of the hill. So as a percentage, I think underground is going to be higher at Las Conchitas. This is like a guess. I don't even have the numbers in front of me, but I would say as a percentage, underground is going to be higher at Las Conchitas than as a percent it was over at San Albino. And I think we were like 60-40 thereabouts percent, like open pit underground when we came up with the San Albino model. So 50-50 or 40-60, I don't know, see what the numbers are, but it's probably going to be a little bit weighted towards the underground. But at the very least, we have like a core of this 5-year plan for the open pit. And guess what? Will allow us to do exactly what we did with Las Conchitas, to use the cash flow coming from this, go on the next satellites and start unlocking the code, and then hopefully supplement that with additional assets and companies and people and personnel that will come from the utilization of our platform, which includes our team, our human resources, and then our availability for capital that frankly a lot of companies don't have access to right now. So with that, open up the door to any questions that you might have.
Thanks, Akiba. So we had one audience question, which I think you did a really good job of answering already. But the second part, I think I didn't hear an exact response to, so I don't want to get in trouble and not ask questions that are asked. So the full question was, how has the USA political relationship with the country affected the company and its success? I think you answered that part, but particularly the latest president's order, I don't think you touched on.
Hopefully there hasn't been a new one, right? So
That's the last impact. But I don't follow Nicaragua as closely as you do.
Actually, by the way, when the October sanctions last, I didn't even know they came out. I think I got like somebody actually asked me this, literally the same exact question on Twitter. It says that what do you make of the Biden sanctions? They're like, are you talking about the ones that happened 8 months earlier? It's like, no, I'm talking about the ones that happened 10 minutes ago. It's like, oh, better.
Okay, well, maybe we can ask the individual that.
So with that in mind, it is fair to say that the relationship between the senior levels of the Nicaraguan and the U.S. Government are not good, right? So they don't like each other. To the extent that there was a willingness to take the Trump sanctions, because this started under President Trump. And then kind of push it by the wayside because it really wasn't something that was sponsored by this administration. Was obviously it became a much bigger factor in the State Department this time around, and they clearly do not get along like each other. I think finally they have a diplomat over in Managua right now from the U.S. government, but they intentionally made him a charge d'affaires as opposed to an ambassador over there, kind of as a signal that the two governments don't get along. But, and here's the big but, is that I don't think our understanding of the U.S. position was that they wanted to interfere with transparent Western mining companies operating in Nicaragua. I don't think they wanted to interfere with the general prosperity and growth of the communities within Nicaragua. We're in an interesting part of the country in that we're really at the border, all the way in the north. So a lot of the immigration is like we're at the transit point over here, and we do see direct impacts of policy affecting people, right? People that transit, and even to our employees. So we've had it's kind of interesting. I don't really follow a lot of the immigration policy over the U.S. government closely. I mean, I'll see it pass by my screen every now and then. And then 3 days after a policy is implemented, I get like a call from our team over in Nicaragua. Say, by the way, we lost like a couple of lab technicians, some important ones that we've trained up. We've lost some maintenance supervisors, some people that we've trained up because they responded to a particular policy within the United States and actually use that as an opportunity to emigrate. So it's almost like I actually see the importance of it directly as it relates to our mine. And then from the U.S. government, I think there's a rationale to make sure that things aren't destabilized, because that actually could put a lot of stress on the immigration routes. Now, I was down in Nicaragua a couple of weeks ago. I've never seen more Americans there than I have. And this is going back since 2014, so before any of the civil and social unrest that happened in 2018. Thank God I'm now able to avoid flying on Avianca to get down to Managua. So I took a new route from American. United flies there, Delta flies there. So the practical implication on the ground is that things are status quo, and Americans are welcome in Nicaragua. If anybody's actually gone to the country, it's peaceful. It's nobody's super tense right now. That may have been a period of time in 2018 that was not the case, but everything is kind of like level. I don't want to minimize the fact that there are very, very real issues between the two governments. And then from an investor's perspective, there are like a few stages of what you have to look at. Is do you take a stage where do I want to invest in companies that actually have bad geopolitical relationships at the senior level? It makes an entirely rational approach. There's what types of risks do you want to take in mining when it comes to geopolitics? Because I think if you're going to be a gold mining equity investor, in general, your portfolio is going to have geopolitical risk associated with it. And then sometimes those are obvious risks, and sometimes those are less obvious risks. Even operating and building a mine in the United States doesn't have a complete elimination of geopolitical risk, like permitting and regimes. And NGOs are all part of that the geopolitical risk profile. But you have to take a look at what kind of your risk factors are and manage your portfolio appropriately. Operationally, nothing material changed. Like we operate under the same conditions as we did before. We export our gold to the United States. We've obviously had to upgrade our compliance within our systems to make sure that whatever new sanctions or laws that come out is that we're adhering to the letter and spirit of those laws. But other than that, it's from a geopolitical perspective, nothing has really impacted us other than general market appetite to finance and our general cost of capital.
How has inflation affected you, if at all?
We had a clear big bout of labor inflation in 2021, right? Where it was a confluence of events where we were losing a lot of people who were using this as a once in a generation opportunity to make it to the United States, and then we had to compete not only with Nicaraguan salaries, so we like to pay our employees above market rates within the country, but it got to the point where we were actually competing with what are you getting paid in Miami, right? So there was a one-time adjustment to to local salaries, anywhere from 30 to 50%, depending on where you were in our operations, to arrest some of that loss of personnel for immigration. The broader effect is that they were kind of like competing items. So we had the broader inflationary pressures globally, right? So that's a net negative. And then we're kind of like in plant optimization mode. So we're getting better at how we process this. So the net effect is that from our cost basis, it's like, and by cost basis, I'm talking about like a unit basis, like our AISC and stuff like that are going to be directly influenced by head grades and things like that. But if you look at moving like a ton, moving and processing a ton of material, costs have actually been coming down over time as we get better with that. That's not that Nicaragua doesn't have the same inflation pressures as others, but this is mitigated by efficiency.
Some additional audience questions. So how much capital do you think it would cost to double production rate from 1,000 tons per day to 2,000 tons per day if you were to build a new mill? A rough estimate simply to understand the size, please.
Going to 2,000 tons a day. So there's like the civil works footprint of what we have, and then kind of like adding a little bit of kit here and there. I think you can plausibly get our operations running 1,200, something like that. And that would be like running at 95% availability and everything is expanded. So to do that, and I'll get back to the 2,000 ton question in a sec, but to get to the 1,000 ton, that's like a nothing burger in terms of CapEx from a fixed infrastructure perspective. So it's like $4 million for all the new equipment that we have, and a lot of that is related to actually generators. I was down in Nicaragua 2 weeks ago, and we got like a back of the envelope estimate for hooking up to the grid. And this is one where I'm like, we're never going to hook up to the grid. We're too small of a mine. It's too much capital. And this is why you always have to ask questions, right? So it's never accept the lazy, let's say, intuitive response over here. You always have to ask questions. Get back this like back of the envelope calculation over here is that it probably is not going to cost more than like $1 million, $1.5 million to hook up to a substation that's pushing close to 15 miles away. Which I was like off by an order of magnitude in terms of what I got. I still don't believe the numbers that we got from a back of the envelope perspective, but you can, if you add that, let's call it like a 5 or 6 million to run this at get on the grid, run this more efficiently, lower your energy consumption costs by half.
Curiosity,
and then
what is their base load like? What's energy generation in Nicaragua predominantly?
It's not cheap, right? So that's the other element about why I was kind of suspect about doing that. It's not like we're getting hydro power from Quebec, right? So you're talking about something like, I think our gen sets right now, running it now reasonably efficient. We get our cost to about like 35-36 cents a kilowatt hour. And I think if we were hooked up to the grid, you could probably get that down to 17, 18. So it's not like 5, right? But it's something like that. But there is, let's put that in perspective, just for energy generations at a mill that's doing 630 tons a day, we spend just on energy generation, probably pushing about $300,000 a month. So it's not an insignificant amount of fuel that goes into this. So you figure, what is the CapEx offset? What is the return profile, the payback that you need to basically cut your effective costs, ceteris paribus, that we're still running this at 630 tons a day, by 150 grand a month. So does $1.5 million make sense? $1.5 million is actually a pretty good payback. Does $5 million make sense? It does not, relative to our mind. It may actually make sense when we prove out everything else on the site, but based on what we can like touch, feel, lick, however you want to describe it, it's kind of difficult to justify those types of CapEx investments.
And what about solar panels, things like that? Are you able to generate some of your own power?
Rains, like to me, like I think there are places that are very well suited for solar. We're not.
Okay.
Now, that being said, from a green perspective and an ESG perspective, you'll notice in our presentation, we may have a slide or two over there. It's like, I think a lot of the ESG is there to kind of like unlock the magic code to get this investor to invest in you because you're ESG. It's like, it's not how we operate. We operate is that we are stewards of capital, and we are stewards of the environment in which we operate. So we're the only company in Nicaragua that uses a filtered dry stack tailings storage facility, state of the art. We have visitors from the government all the time. They not only do this to pat us on the back for what a good job we're doing, but also to needle the other guys in the country saying, you may want to do this as well at some point in time. And we make sure that our relationships with the community and making sure that we actually have like real-time support to make sure that we don't impact the environment more than what we absolutely need to run these mining operations. The other thing is that the fact that we have high grade has a direct implication to what our ESG standards are. Is that there's a limit to how environmentally responsible you can be if you have a low grade deposit, because there's a lot more material that needs to be moved, right? So at high grade, there's just less impact, at least for the ore that's going through the plant. It helps not only from a margin, like the ability to finance things like that, because it does cost a lot more to run a filtered dry stack tailings storage facility like that. But also from a practical perspective, is that if you have high grade, you have more gold ounces per ton that's needs to be or less tons per ounce that you need to deal with for your tailings management and eventual reclamation.
I had a follow-up question to the solar cells one. From the viewpoint of ROI, is there too much rain for solar cells? I think the answer is yes, but put it to you.
Yeah, it's like solar cells. I don't want to say like it's impossible. Like for us, it's not like we're where the marginal guy where that will be benefited. So I applaud especially the large scale companies operating in very dry and sunny locations. Absolutely, it makes all the sense in the world. So congratulations to people like I'm not going to name them, but you can probably go look them up. I think there's a lot of people that are using a lot of innovative technologies to lower their carbon footprint, and we applaud them. We're smaller, so there's less things that we can do. We obviously watch people to see where efficiencies lie, but the biggest effect and the biggest way for us to limit our carbon footprint is just by having a high grade mine, and there's just less material that needs to be moved for a similar unit of production.
Okay, and then sorry, there's a lot of questions, so I'm trying to keep it thematic. So just going back to potentially doubling plant throughput, do you have an anticipated timeline on that?
So this is one where I think I've done an improved job of explaining what capital requirements are to double it than I used to, right? So where I used to say, I don't think the CapEx of doing the expansion from like the 600 to 1,000 tons a day is much different than what we were explaining in 2019, 2020. It's always going to be taking like that $4 million number. The real thing, which is required, which is a much bigger CapEx expense, is that if you run, and it's more subtle, but equally more important, is that if you run at 1,000 tons a day, let's say to keep the math simple versus 500 tons a day, you better have twice the amount of resource that you're comfortable depleting than if you had 500 tons a day. Otherwise, your hamster wheel is getting the hamster bigger or the wheel smaller, but you're running quicker one way or the other in order to deplete your resource. In doing that, for us to get our resource, we put like these kind of like allusions to how big our resource over at Las Conchitas is going to be, where we have this internal open pit mine plan of 5 years. Everybody's going to see what the results are later this quarter on what that resource is, both open pit and underground. But 5 years at like 500 tons a day, 600 tons a day, as the case may be, there's a lot of drilling that needed to be done there. So we did 75,000, 76,000 meters of core drilling, and then another 8,000 of RC infill. I think we actually stopped the main infill program yesterday, actually. So it's probably going to peak out at about 8,800 meters thereabouts. So let's say 85,000 meters to get 5 years at our current throughput. That's 80,000 meters to get to 2.5 years, right? At the 1,000-ton day. And the overall exploration spend to get on that was probably running us, let's say, all in $140 a meter for core, and then let's call it 90 all in, maybe a little bit less than that for RC. So you're talking about what is that? 140 times 70,000. You're talking about probably something that's about $14 million. You're going to need to make a decision just to get like resource and basically have that hamster kind of stabilize. That's a CapEx that probably looks a lot like what we were spending, because it's not just the drilling for resource. We also do exploration work elsewhere over at our property. You're probably going to be looking like at a spend that approximated what we were spending in Q3 of last year, this $3.9 million a quarter number, in order to get us to that depletable resource that we feel comfortable. I don't think I would feel comfortable running this with a 2.5 year mine plan, because it just takes so long to do. So the real capital is about whether we're going to be allocating that type of capital to our exploration spend, rather than the actual capital that it's going to take to do the plant. And I know we fall into that same trap too, is that when we think about CapEx, we think about like big stuff, plant and crushing stuff and squeezing stuff and milling stuff. The real capital is the information, the drilling stuff.
Resource delineation, yeah. I had one specific question related to CapEx, which is there a waste dump completed for higher throughput? I guess that would go in the category of the physical CapEx required. Maybe you can give an update on what would be required in terms of a waste dump and other things.
Yeah, so we've started to fill the second newly permitted waste dump. That's towards the north of Las Conchitas. I think you can see actually the map that I put out this morning is and even this one over here. So you have Las Conchitas starts with San Albino, Francisco. If you squint your eyes on the screen, I can barely see it on my computer over there. It's all the way on the left, Mina, Francisco.
On, so I've just put my eyes just to see you, Akiba.
right. Well, good. It's probably for the best. So Mina, Francisco all the way on the left within Las Conchitas, and then Bayacun all the way on the right. That's left is north, right is south. So it's about like 2 kilometers thereabouts. It's going to save a lot of money if we actually have a waste dump closer to Bayacun for the Bayacun waste. So eventually we're going to be building our third, potentially even fourth waste dump over there. And then the west pit. So there's a few pits over at San Albino. There's the west, central, and southwest. The west pit will probably get depleted at maybe late this year, early next year, something like that. And we can actually use the west pit as a fourth pit, and then that can actually help kind of manage the logistics of. We'll put some of the Las Conchitas waste over there, and then kind of lower the hauling costs. And to put that in perspective, let's say like the 330, 340 a ton type mining costs that we have. I would say incrementally, like the longer hauling distances, because we're deeper in the mine and distances like we're talking about a couple kilometers here, it's probably going to add like a good 10-15% of that. So management of your hauling costs can actually save a lot of money, or avoid spending the money, however you want to look at it.
And then what kind of guesstimate percentage are left to acquire of Las Conchitas surface rights? Is there any budget left for El Golfo or other satellites? Sorry if I missed how much was left, if any.
Yeah, so we're ready to go. We submitted, actually when I was down in Nicaragua, we had like these huge, and those like movies about that legal teams that are trying to crack the code, where you have all these boxes of papers. So we basically delivered these 10 boxes of thousands of pages to the government, say, here, there's our EIA. So all of the surface rights that we needed for the EIA which allows us to do this 5-year open pit, are now been submitted to the government. I guess that was 2.5 weeks ago. I just got word from our country manager that we've scheduled our community consultations on this. I think the beauty of our relationship with the community is that at the federal level, we got our complaints, and at the local level, we get our complaints. Everybody knows that we're kind of like an open and transparent group, so their complaints are coming from actually being part of the same team, as you will. So I actually don't think that there's too much risk of lack of community support, and we have an open dialogue with them. And then everybody is kind of like, I shouldn't say everybody, but 95% of the community is fully on board with what we're doing. So all of the surface rights associated with, let's call it that initial 5-year plan, are now in hand. There's a few things over at the margin that we still have to acquire. Both of that is some of that is financial, and then some of that is stuff that you actually just kind of like need to do as a steward of and a responsible citizen of your local community. I mean, there's this one actually rather important piece of land that we have where the owner actually is mentally incapacitated. So we had to go through a lot of legal maneuvering to make sure that his family was aware of what we were doing, to make sure that the right powers of attorney are the right local judges are making sure that there's a fair process in what to do. And stuff like that. I think we started with that negotiation with his family, now going back almost 4 years, and then it took us that long to get like this parcel. So sometimes you have to deal with. I mean, that's the thing that I think investors they know about it. If you like ask them the question, but they don't know about it. They know about it, but don't know about it. Where a lot of people that invest in stocks, they think it's like, all right, it's a stock, so it can go up, down. That's what I'm here for. There's a lot of like individual complexities that eventually can have like pretty material effects on the path of the company. Like this decision of mine to do this permitting piecemeal is a good example of that. So it's not like turning on a switch with, it's not a widget factory. And then we have some particular complexities associated with us in terms of our geology, our metallurgy, the broader geopolitical situation, and that you have to manage and work through.
And could you please discuss expectations for revenue and net income going forward? Are you providing guidance?
Well, we cannot provide guidance because we do not have a reserves, right, which is a pre-feasibility or better until, right? You always have to like kind of read these various bits of legislation and their caveats until we have 3 years of audited revenue in excess in aggregate of 90 Canadian million dollars, which I believe will happen next April. So we will have our maiden guidance in late April or early May of next year. Until that time, it is 100% against 43-101 to do that. I know other companies do that, and those other companies are not adhering to 43-101 standards. Now, what we do provide, the ability for our investors to have a sensible expectation of what to do. So we kind of like put these Easter eggs out that allow us to communicate what people should be expecting. So this internal 5-year plan, which again can be revised once Steve and Matt finish their work later this quarter. That's an indication, and that's obviously predicated on the assumption that we're not doing the expansion. We may do the expansion, but at least that 5 years assumes that we're running at a similar throughput, and then predicated on the assumption that a lot of the issues that have happened really since late February because of that permit delay, a lot of those things resolve. So obviously we're going to have like a nadir of cash flow, net income over here. And now that Las Conchitas is back up and running, it's going to take us some time. Like I said, the head grades have already are up by 2 or 3 grams over the last week or so since we started processing Las Conchitas material, but it's still going to take us a while to ramp up and get to the good stuff. So that infill results that I put out this morning, for instance, this 11.5 meters estimated true width, 12 grams material, 15 meters from surface. Last week, it was 30 grams, an ounce material, over 4.5 meters estimated true width, 13 meters from surface. Today's was from Las Conchitas South, so that's the Bayacun vein all the way on the right, and then yesterday it was from Mina Francisco, that vein at Las Conchitas all the way on the left. We've started to mine the first part of Mina Francisco, and then in order to get to that good stuff, we have to go all the way down 13 meters. So it kind of plays with people's minds. It's like you see these drill holes, so it's like, oh my God, I invested in this other company. They had like a similar gram meter profile to you. It's like, well, how deep was it? It was like 500 meters deep. That's not the same thing. It's like, oh, I saw this other exploration company. They put a similar gram meter out with you. Are they an exploration company? Do they have like permits in a plant? Not the same thing. When we talk about ounce material over 4.5 meters, 13 meters from surface, it means that material is going to turn into cash flow within the next 6 weeks. When we talk about today's results, 12 grams over 11.5 meters estimated true width, that means that is turning into cash flow in February. So this is what we mean by our results are not really comparable to other exploration. Even though we are an exploration company, I don't view ourselves as a production company. I view ourselves as a self-funded exploration company because there's a lot of stuff that we need to do internally. And then there's a lot of stuff that we want to do from a corporate perspective, looking outward as well. But it plays with people's minds is that we are an exploration company, but we have an operating plant and a team to produce that takes these drill holes and turns them into cash flow in the context of an investor's timeframe and horizon, which is something that other exploration companies just don't have.
Okay, and a couple more audience questions. The consolidation of the shares was intended to allow a move of the trading to a higher market. Can you speak to that process? Is it on hold?
It was a few things that it was there for, right? So all surrounding the general, let's call it, market appetite for the stock. So there was two components of that. One was this let's call it to a larger exchange uplist, and I'll go over that in 1 second. And then the more direct one was the ability for Mako to be index eligible, specifically to the Prime Junior Silver Explorers Index. The SILJ is the ETF that references it. So that index required for Ascension for new constituents to have at least a US 20 cent a share stock price. We were trading at below that. So we needed to do a split to do that. We assigned 10 for 1. Tickety boo, Bob's your uncle. We actually were able to do that, time it, and we got inserted to the index. And there was hundreds of thousands of shares of demand. In fact, the index still owns 390,000 shares of Mako, down from about 600,000. And I think they sold that Mako position I have my own conspiracy theories as to why they did that. But my view of the situation is I think they sold it as a mistake. And I think that actually gets reversed in September. So that was the proximal reason for the split. The secondary reason is for an uplist to an exchange. And there's a few things that the TSX wants to see, and I would imagine New York various exchanges would want to see as well. Is that you need to have a balance sheet, and in their estimation, it's an 18-month self-funded budget associated with it. They want to make sure that you have like a sufficient amount of working capital. So a lot of things that we need to do on a debt refinancing, which was to push it out, reprofile to make sure that our accounting working capital was positive, and we had an 18-month budget. It's a weird situation in Canada, is that even though we have been mining for 4 years and we've been producing for almost 2.5, is that because we don't have reserves, they don't take into account revenue projections because we don't have reserves on our asset. It requires some level of history and execution for them to basically bend the rules a little bit, if you will, to ascend them. And I think they were there. So I actually don't think that was much of a risk doing the extension of the TSX. The one thing that it's like every single 1 or 2 quarters. It's almost like reinventing the wheel with some of our accounting over at the company, because what we do is so novel. Every time we approach PwC or our external accountants over here about our approach to doing things like depletion accounting and things of the sort, it's like it becomes this exercise about counting angels on a head of a pin. It's like it potentially like large ramifications to what this means in terms of our net income and things of those. But in terms of how it affects operations, it's nothing, and it's stuff that I don't actually like to focus on. But it does slow things down. And our biggest risk about going from the TSX-V to the big board TSX is that our reporting requirements get accelerated by at least 15 days for an intra-quarter and as much as a month for our audited financials. And I still am not 100% comfortable of our ability to go and have a seamless delivery of our financial statements in an accelerated time frame until we have full buy-in from every. We have she's wonderful partner. We have a new partner over at PwC. And like every time we have a new partner, it's like explaining the same thing again and again. And then like part of the equation over here from last year is that, and I don't want to be like flippant about it, is that I thought that people would care. I just people don't care like now. So I don't think it's actually going to enhance our liquidity. It's like people just want to look at it as a heuristic. It's like, oh, these guys are in the TSX. That means they're real and they're producing. Nobody cares. It's like it's a tough market right now. And there are things that I kind of want to focus on more than TSX elevation than we were in almost like an existential crisis with this permit delay, and luckily that happened before things became really problematic. But that was really where the focus area was on from management's perspective, because of ramifications and decisions that were made after the sanctions were announced in October last year.
Okay, then 2 final audience questions. So why the need to do an acquisition? Would it not be better to sell the asset to a global producer given the significant amount of exploration work you've done?
It will always be better to sell this asset at a super high price, because then I can go to the beach. We don't have to deal with this. Don't have to deal with like crazy Avianca ticket lady anymore and everything that goes with it. Okay, I would love it. Like show me the bid and then we can evaluate. I'm operating under the assumption that we need to grow before we could sell, and whether to be to another company or even to the broader public markets. Wexford is really, really good at this. I think I've been trained well by Wexford as well on this. Every day is a new game board. Every day is a new decision. And we make the best decisions that are available to us with the facts that we have on the ground. And then really it's our job to kind of execute the business plan, both operationally and then even to a certain extent positioning the company for types of exits like that over time. But if somebody wants to pay me a lot of money for this asset, yours. So we're not, there's no like handcuffs or any hesitation about doing things. We look at this as doing the best things that we can for shareholders all the time. Sometimes we make mistakes. Sometimes we're wrong. I like to think that most of the decision processes were made rationally. I think one of the reasons why I piss so many people off so often is that because I do have a level of rationality that sometimes interferes with people's levels of irrationality. And sometimes there's friction when that comes about. But I can say we always look at the best things to do for our shareholders at any given day, any given time, and we're willing to shift and adjust if those decision points change.
And the last question that I have from the audience is there anyone on your radar for M&A? Obviously, you can't give us names, but maybe you can give us some categorizations of what you're looking for.
I think to the last question about selling, right? So I think the universe of acceptable buyers is actually larger than the universe of assets that we can acquire. Just because if somebody actually has like a larger platform and a business, you can kind of take a look at different jurisdictions right there. For us, we're like a small team. Like we have our headquarters, our nexus, our brainpower in Tucson, Arizona. We have like our logistics team over in Managua, and then the 95% of our employees in and around El Jicaro by the mine. So for us to actually acquire something, it needs to be something that's not going to overwhelm our ability to manage it. So we're kind of confined within time zones. I'm actually I'm very impressed often with some larger mid-tier companies and even some majors. Like one of my very good friends, my first boss in the industry, used to work for SSR Mining. So like I use them as I don't like to talk about other mining companies, but I'll say nice things about them. I actually think they did a really good job of M&A and horse trading over time. I think they started their business with inferior assets, and they were able to horse trade into like a really good mid-tier mining company, and were able to manage across multiple jurisdictions. And as kind of like a small mining company growing into like a true mid-tier, I think they've done an excellent job. We're not set up like that. So I wish we could do that. I'm not the CEO to do that. No issues replacing myself to find a CEO that does that. So we have to kind of like work within the confines of what we do well. So we're scrappy, and so we like assets that really suit our needs. So they tend to be on the smaller side and things that are overlooked, and that's both in terms of what we're capable of handling. That's both because we have zero confidence in our ability to access Canadian capital markets. So we have to kind of like operate under the assumption about what Mako can do by itself or with the help of the controlling shareholder. And then likewise, things that kind of make sense from a valuation perspective, and things that actually get above a certain level, the valuation gets to a point where there are likely better buyers that have better access to capital. So it's not like I get this like criticism, like why are you always like looking at smaller size assets? Part of that, I think, is like very rational reasons. Is that smaller assets are easier to manage to a certain extent. Some like smaller assets have their own issues and complexities as well. But it's also the other intangibles, where there's like a level where we would probably look at larger assets if we had a strong currency and the ability to have like a broader, let's call it management, a corporate level management team that can manage across time zones and jurisdictions using the SSR example is I think as a lodestar for success. So, but that's just not us right now. So it's going to be kind of like on similar size profile assets, and then within jurisdictions where I don't need to be awake 22 hours a day to manage the business.
Okay, one last question for you, Akiba. So what are the catalysts and major news items to look for over the next 3 to 6 months? I know you touched on some of them, but it'd be great to have you just summarize them for investors. They know what to look for. Yeah, so like even like for the last week's news release that came out, I was actually planning on like just not releasing. They're infill holes over here, and then there are RC holes. So we don't actually use the grades for grade estimation, although we do use them for refining our geological model. We did our greenfields exploration program. Like I told our guys, you have 1,000 meters, make a discovery. They got their 1,000-meter budget, made a discovery. So it's like so those exploration holes are out, and as everybody can see, there's FFAL interest in the public markets on the back end. So I think from an exploration side, it's like, all right, you see what you see. Las Conchitas is going to be there. We're going to use this information. We're ironically we're mostly done actually writing the 43-101 report, but we actually don't have our estimate yet.
So it's going to take some time to finish both the open pit and underground. By the way, this is one of the things that I want to bring up. So I get this from folks. It's like, wow, you kind of delayed your 4301. There must be something that's wrong about it. The estimate that we had internally at the end of last year is like within 5% of on the open pit. On the underground, I actually have less of a strong view on what that looked like a few months ago. But on the open pit, it's like within 5% of what it's actually going to be. So there's no surprises on that. But the amount of time and effort that we have to go into this thing. So we have this very detailed geological model that we need to go through. Complex, or like the stuff today is a good example, is that we don't have an 11.5 meter wide single vein that's going to run through our 188 square kilometer ground. It's like, this is one where you have a series of vein structures that we have these thrust faults that came in. Like, that's kind of what orogenic means, is when these mountains came in to get built, and they wound up having vein duplication, and you have like boudinaging going on. So you have these like lenses and large scale like blocks that you have to do. So when you actually go and do the geological model, it's like, we're going to be mining this. So I'm not designing this resource so I can have a guy who writes a newsletter say, wow, this resource looks good, bad, ugly, and you're rich, cheap, expensive on the back of this. It's not what we use resources for. We use resources to design our mine plans around. And in doing this correctly, we need to drill these things out. I think our infill program, as we alluded to in the press release this morning, has now taken things down to 15 meter spacing over Las Conchitas. San Albino was taken down to 10 meter spacing. Even at 10 meter spacings, we needed to take channel samples along our deposit that in cross section was probably done 4 meters apart, and then making sure that we had lithological controls at that 30 centimeter threshold level for our ability to control dilution. You still have to take it down to that level. So we're operating under the assumption that 10 meters wasn't tight enough. So 15 meters, we're going to loosen up on some of the data. And then now that we actually have some experience and thresholds for how we're going to be mining it, we'll take it down to 15, which requires 85,000 meters of drilling to do our Las Conchitas resource, which, by the way, is completely open along strike, completely open down dip associated with it. And most of the drilling that we did over Las Conchitas, unlike San Albino, which had a few deep holes, Las Conchitas, 0 deep holes. So there's nothing that was drilled more than like 100 meters from surface, thereabouts. I've gotten criticism recently from like, why doesn't Mako put out a feasibility study? Why don't they put out from cash flows? Ironically, I got that criticism from a guy that was on the Golden Rain, a PEA over there. And I nearly lost my shit when he wrote that. It's like, you guys are signing off on things that just are not accurate. And I do not want to put out like documents that don't have some sort of basis in reality, just because you need to have the simple heuristic, because mining companies deserve to have like a feasibility. We don't operate that way. It's like, if you guys want to see what our cash flows are, great. We're a public company in production. See what our cash flows are. You want to see what our great. We'll put out whatever we want, cross sections, long sections, anything you want. We'll show it. Don't think that we're going to be putting out bullshit just because that's what the industry requires. And like we've never played that game, and we don't intend to. And for the people that want to criticize us for that, fine.
Okay. Well, I don't have any more questions. I don't see any other audience questions. Is there anything else you wanted to talk about today that we didn't cover?
No, I mean, that's kind of where like Mako is. It's like it's kind of a weird market, right? So it's like the 2000 and let's call it 2013 to 2000 and early 2016 era was gold prices actually really got smacked upside the head, and everybody came into that with balance sheets that were ballooned. There was like an existential crisis to the industry about whether or not it was viable, right? So there you have very good reason for stocks to be trading at historical lows. That obviously there's great opportunities during that time frame. This is a little bit different, right? So nobody's and at the macro level, nobody's balance sheet is really all that stressed at this point. And then you have the commodities doing fine, and then there obviously has been a compression in profitability across the industry because of inflation and kind of just changing mine plans as people got more confident about going after some of the harder stuff for the last couple of years. But there's like so much apathy out there in the market that one of my biggest issues is like, well, how do we get people to care, right? So that's it's a tough one. Like honestly, I wish I had like a great answer for folks. We do what we can, inclusive of having like webinars like this, inclusive of doing the stuff that we needed to do to get index eligible, to make sure that there was a modicum of liquidity coming into the names. And if there's going to be situations that we need to do to improve, we'll take advantage of it. I think M&A is going to be an important part of the story. I think making sure that we don't put ourselves into a position where our balance sheet is actually going to affect business decisions, which usually that actually wasn't the case. Like really through our entire life cycle, we kind of made, I think, rational business decisions irrespective of where we were on a balance sheet. I think that changed a little bit towards the end of last year, and I don't want to be in that situation again. So it will be tactical about how we approach that. But I do think like even stuff on the refinance was helpful in that regard. And then we do what we need to do. And like we're fortunate is that we have like a very well capitalized backer over here, and we try to make good decisions, rational decisions. As I say, sometimes those rational decisions work really, really well, and sometimes those rational decisions wind up not working. But it's not like we make decisions that we think are anything other than doing what we think is the best thing for our shareholders. Simple as that.
Makes sense. Well, thanks for the update, Akiba, and thanks everyone for participating. If anyone has any additional questions or would like a meeting, feel free to reach out to myself or Akiba, and I'm sure he would accommodate you. And yeah, just thanks everyone for their time. And thanks to you, Akiba.
All right. Thanks, Deb.
Have a good summer.